Dividends. This video is all about Dividends 101, and during this video specifically, you'll learn about dividend investing, how it works, and if it's the right strategy for you. Now, before we jump into the video, my name's Love, and welcome to Love's Wallet, where every week I like to break down financial topics as someone who's trying to become financially responsible in their 20s. So if you're new here, please be sure to like, comment, and subscribe, because trust me, this will be a great video, so let's get into it. To own a piece of any business, you need to first purchase shares. Everyday people, you and me, can own shares of a business by purchasing stocks on a brokerage platform. During each quarter, every 3 months, companies have an earnings call to share the state of their business. And if a company you're invested in makes a profit and has extra money, then they might decide to reward their stockholders. But how will they reward them? Well, with money. So instead of using the profit to acquire new businesses or reinvest in the business, companies instead reward their shareholders through dividends. Now, you, the shareholder, basically receive money from the company in the form of a dividend. And with that extra money, the dividend, you can now reinvest it back into the company or purchase other stocks. And now, before I continue, let's just do a quick recap to make sure we're all on the same page. So when it comes to dividends, right, it's when the company rewards you with money for owning their shares, which means dividend investing is trying to find stocks with a good dividend yield to maximize the amount of dividends you can get every year. Again, let me pause here and let's do a quick example with the McDonald's stock. So let's say you buy $10,000 worth of McDonald's shares during the year. When looking up the company, they have a dividend yield of 2.6%. So this means for one entire year, assuming you keep the $10,000 in McDonald's, the company will pay you $260 in annual dividends. And now the dividend yields a company offers changes from year to year. So sometimes the yield might increase or decrease over time. So be mindful that if you see a stock with a 20% dividend yield, it's possible that it could drop to 2% next year because maybe the company's not making as much profit as they were in the previous years. Now, not all companies pay dividends. So if you want to see if a company does or doesn't offer a dividend, please be sure to check out their dividend yields. And most importantly, dividends are usually paid every 3 months, but other companies might pay monthly, yearly, or to be honest, whenever they feel like it. So in the McDonald's example, that $260 will be split between 4 quarters, which means every 3 months, you will receive around $87. And another important thing to note is that there are 3 key dates to know when it comes to earning dividends. That is the declaration date, ex-dividend date, and the payment date. The declaration date is essentially like when the company declares that they'll give out a dividend. And this is not as important because you will probably already know if the company is or isn't going to give a dividend, since that's the reason why you're buying the whole company. The ex-dividend date is the last date an investor must hold the share to qualify for the dividend. So if the ex-dividend date was March 1st, you need to own the stock before that day in order to receive the dividend. And lastly, the payment date is when the dividends will be deposited into your brokerage account. Again, these are the 3 key dates you need to remember. So after meeting that criteria, then you will finally receive your dividends. It's also important to remember that since a company is giving you money in the form of dividends, that money is taxable since it's categorized as income. So depending if the dividends are ordinary or qualified dividends, you might receive different tax percentages. But in this video specifically, I'm not going to dive into the taxes or the tax strategies with dividend investing. But if you're interested, as always, I would suggest you talk to a CPA because they can help you figure out the best strategy when it comes to your tax planning. So to recap everything, if you buy stocks or index funds to grow over the long term, that's just regular investing. But with dividend investing, you're focused on selecting specific stocks that have a good dividend yield to increase your overall dividend payments. The general concept when it comes to dividend investing is to buy dividend stocks, get the dividends, and then reinvest those dividends, and then you can retire early and live off of that passive income. Before diving into dividend investing strategies, I need to make sure you're aware of these 3 common dividend investing misconceptions. These 3 are important because a lot of people make these mistakes or, they think these things are true. A common one is that dividends are free money. No, you invest in a company and they magically give you the money, right? That's how dividends work. No, you don't just invest and they magically give you the money. When companies give out dividends, they're giving their shareholders money that could have been used to further invest in the company or even acquire new businesses. That money could also be used to buy back company shares and making your current stock holding shares more valuable. So there's other things they could have done with the money instead of giving it to you. So in reality, dividends are a transfer of equity. Remember, there's no such thing as free money. So instead of reinvesting in the company or buying businesses or buying back shares, they give it to you, the shareholder, to kind of reward you. And with that reward, it entices people to keep buying their stock, because again, the more shares you own, the higher your dividend payments will be every quarter. The second misconception that first-time dividend investors have is that they solely focus on the dividend yields. Don't do that. Like when it comes to finding good dividend stocks, do not solely focus on the dividend yield. Solely focusing on the dividend yield is not a good indicator if the business will perform well. Because this business has to make money at the end of the day. You need to remember that the basics of investing is about finding good businesses. And now these businesses need to have a good record of generating profit, but also be sustainable. And while if you might see a 20% dividend yield, that might seem exciting. But what if during that year, right? Let's just say company A went from $100 to $30 due to it being a bad business and it has a 20% dividend yield, but the stock price dropped $70. Assuming you had like $10,000 invested in company A, that $10,000 is now worth $3,000, and your 20% dividend only brings your total return to $5,000. But remember, you started with $10,000. As you can see, solely focusing on the dividend yield is a bad idea. There was another YouTuber that said this great analogy, and it goes basically like solely investing in the dividend yield percentage of a stock, right? Choosing it based on that one factor, it's like buying a car based on its color. And when it comes to dividend investing, you need to make sure you're investing in good businesses. And if you want to know how to find good businesses or what to think about when it comes to dividend investing, don't worry, give me a few minutes and I'm going to break that down. For the last misconception, dividend investing is not always the best investing strategy. Since you're receiving money from multiple companies, right, that give out the dividend yields, most people think that this means that they're earning more money than regular investing. And by regular investing, I mean, again, just picking individual stocks or regular index funds without considering the dividend yield, right? Since you're getting paid, I'm making more money. But actually, that's not true. There was another YouTuber, Toby Newbat, who did a great study where he selected individual dividend stocks and saw how their total return performed against an S&P 500 during the last 10 years. And by total return, I mean that he found the percentage growth in the stock prices and then also reinvested those dividends over the years. Now, throughout those 10 years, the results are kind of surprising. As you can see, just simply investing in the S&P 500 outperformed 3 of the 4 dividend stocks. And now, this study is not perfect by no way, shape, or form because it doesn't take into account taxes, and 10 years is a small sample size. But it is a good reminder that investing is totally and always about increasing your wealth. And while it might be tempting to buy individual stocks with good dividend yields and get paid every month, every quarter, in theory, you can increase your money at a greater rate and doing less work, less research, if you just put your money in an S&P 500 index fund. So please don't risk all your money and everything for the sake of a dividend. If you look at 3M stock, they have a great dividend, but their stock price has been decreasing for the past 5 years. And so when you see that dividend, it looks good. However, it might not be a good business to invest in. And by now you might be wondering, if that's the case, then why do people love dividend investing? The number one reason why people love dividend investing is because of the passive income. I mean, again, a company pays you just for owning their stocks and you don't have to do nothing. And I know I said earlier that it's not free money, but here's what makes dividends so special. Since a company is giving you extra money in the form of a dividend, that means that you can now decide how to use that money. You see, if the company kept that money and decided not to give out dividends, then they would have put that money back into the company, whether it was, reinvesting in capital, purchasing new businesses, or just buying back shares. But since they gave you dividends and now you have that extra profit, you can use that money as you please. So maybe you want to use that dividend money to purchase different stocks, or maybe you want to treat yourself to a vacation, or even put it towards real estate. The easiest way to put it is that receiving dividend stocks allow you to be more flexible with the company's profits since it's now in your brokerage account. And the best benefit about dividend investing is the consistent cash flow. By owning stock in a sustainable company, you know that you have a predictable amount of money hitting your brokerage every month, every quarter, or whatever. So if you had stocks and needed extra cash, then you have to worry about timing the market and when to sell it in order to get that extra cash. But with dividends, again, you know that every month, every quarter, you're going to receive a specific payment, whether the stock price goes up or down, it'll be in your brokerage account. So let's say you want to make an extra $500 a month. How big does your dividend investing portfolio have to be? Well, assuming, throughout your portfolio, you have an average dividend investing yield of 3%, you will need $200,000 to invest with. Again, assuming you make no recurring investments to your portfolio and kind of just neglecting taxes, just for the case of the study. So you need $200,000 to start off with. And when it comes to investing with dividends, please keep in mind that my job is not, as a YouTuber or for my channel personally, it's not to give you recommendations, but instead the tools to make good investment decisions. So here are some things that I would consider when looking for dividend stocks to include into my portfolio. The company's revenue, the company's free cash flow, the company's net income, the company's earnings per share, and most importantly, making sure I understand the industry and that I understand how this business generates money. Again, always ensure that the company has a good history of making money consistently. Even when the economy isn't doing great or if a pandemic happens, you want to make sure you find strong and sustainable businesses. When it comes to investing, I personally never focused on dividend stocks because it is not aligned with my investing goals at the moment. Again, when it comes to investing, you always have to have a strategy. And once you have that strategy and plan, the actions you take have to reflect that strategy. So now usually companies that pay good dividend yields are stable and profitable companies. And such companies usually offer less risk, which usually means less rewards. So when it comes to my Roth IRA or my taxable brokerage account, I invest in high growth single stocks since I am starting with a small amount of capital. And again, by small amount, I just mean anything less than $100,000. And now let's think about that previous example I gave. Just to get an extra $600 a month, you would need to have at least $200,000 to invest with. That's a lot of money. And right now I don't have $200,000 and you might not have $200,000. But once I begin to earn more money as I get older and, my job and through my social media content, then I will explore taking a good chunk of that money and putting it in stable and profitable companies that pay out good dividend yields. And a great example of this is Warren Buffett, legit, because he has so much money, and the fact that they're in dividend stocks, his monthly payments are outrageous. It's crazy. I hope this video was helpful. The most important thing to remember when it comes to dividend investing is to never solely pick a stock off of its dividend yield. And as always, please make sure to find good businesses. Let me know how this video was. I was thinking maybe I should add a multiple choice or questionnaire at the end of the video or throughout the video to make them more engaging, but also make sure you're understanding the concepts. I don't know. Let me know your thoughts down below in the comments. And with that being said, as always, please be sure to like, comment, subscribe, run it up, do whatever. I look forward to seeing y'all in the next video.